cable still ranging, it's still holding the gains while it's above 137. But if it dips under 137, 136 might be next. Euro dollar, the same. We hit those highs, 77.80. We've got this support zone at 40.50. If it breaks that, the rally looks like a failure. It's one of the reasons I explain this is not because everyone wants to short at the top and everything, but if you're in the positions that like I was in euro dollar and I'm running a position along, I want to know if these upside levels aren't breaking. And so this morning I came in and I chopped some more of my euro dollar position at 58 because it wasn't taking on the highs. So it's not just about trying to get in a trade, it's how you manage your trades when you're in them as well.
That's very important. You ever manage them from when you have conviction, do you manage them from a longer time frame? And when you're trying to make a decision, you go to your TF 15 minute to make a decision? Yeah,
definitely. Because when you trade longer term, you're looking at longer term charts. You're looking at weeklies and dailies. And the problem that most traders have is they get in a position, they think, right, I'm going to get in this position and I want to run it for 500 pips. And they tend to ignore what levels might stand in their way of getting their target. You can't ignore the levels. You can't rely on a level to get in a trade, but ignore levels that stand in your way. And so when you get to one of those big levels, you have a decision to make. Are you going to take some off?
That's selective ignorance.
Yeah, it is. But it gives you a decision. It's kind of like the
selective hearing that my wife says that I have, which
But then what you do is you've got this big level on your chart that your price has hit. You've got a decision to make. Do I take some profit there? Do I see how it performs? And then you switch to your lower charts, and that's how you see, minute by minute how that level is performing. And if it's not breaking, you got a decision to make. And so that's how you mix up your long-term charts with your short-term charts.
Can I just answer one of our attendees' questions, Jay Joshi? And Ryan, you remember when we were heading up, I had like a 116 number. It wasn't my number. It was Goodburn's number for a high at 116. Remember I was asking you, did you have anything at 116? And you didn't have any major number at 116. And he's asking me, why am I looking to buy? I don't know if I'm going to buy it. I just think there might be one more high, and this is what screwed me up and why I couldn't take the short was this reading on RSI and intraday you had a confirmed high. So sometimes my methodology will keep me out of a trade. I knew the number, but there was no reason, at least here, for me to sell it with momentum confirming the move. And sometimes it happens and then I miss things because most of the time this doesn't happen where you have a market confirming the high and then it peaks. So I hope that answers your question, Jay. Okay.
There's also a lesson to learn there. I'd rather be right and not in the trade than wrong and in a trade. Yeah. Just because of your conviction. We're all going to miss open goals. We're all going to miss open goals.
Yeah. Yeah. Well, I don't know. I can't miss an open goal. and you know what age I'm pushing. You put the ball in front of the net. I could even lay down on the ground and do a header and push it in. So anyway,
that's funny actually. Laughing.
Well, yeah, you're a soccer dad, so Anyway.
And by the way, Ryan, I just want to say great guidance on trading, and I'll be, I was actually just in the chat room telling people how poorly I managed the dollar Canadian this week. I actually, I did not trade it well. It's funny when you're trading the markets, there are times where you totally ignore things that you shouldn't ignore, right?
Yeah.
Yeah, I mean, it's just it's it. So, and just so I can show everybody what I mean by that. This is here. Just give me.
Go ahead, buddy.
And by the way, TGIF guys, how are you?
TGIF, Blake.
Yeah, we do have retail sales coming in, and just so you guys know, this is obviously the ForexAnalytix platform. if you click up here in the upper right hand corner, it takes you over to the chat room. So this is, I told everybody.
Oh my God.
I told everybody they're going to be on Jumbotron. You guys know what Jumbotron is, right? You know,
Who's that?
Hey. So
that was Amanda.
That was not Amanda. And if you say that, she is going to have a word with you, Dale. You know that.
I know. I made a big mistake.
So this is our chat room, just so you guys can see, kind of some of the conversations. This is Forex Flow. Oh, shoot. I forgot to say. I was going to say that to the general chat room. I put that in in the old macro chat room. Oops. There's Simon right there. But you can see this is our chat room. But this is our trades room, and this is I'll just show you guys. Close my crude shorts for negative $1.40 from earlier this week. Just closed my dollar Canadian negative 15 pips on the week. I closed my Canadian yen for a nice trade, and I give Andre credit for that. And I closed my S&P short for the week from earlier this week. But I have not traded really that well this week, and I've ignored a few things. And fortunately, I got out with my I got out in a decent manner, and I didn't lose money. I actually made money. I should have made a lot more money. But that's just that is a part of trading, and I had this conversation, and we should expand on this conversation a little earlier for a little while. And I'd love to hear Stelios and K-Man comment about this too, because this is a conversation that we had yesterday on the daily roundup, which is, by the way, it's a private webinar for the ForexAnalytix subscribers. I was talking to him about it yesterday, and I said, look, I came into 2022 pretty high on my horse. I had a good 6-month run in 2021, great volatility. I did really well, and I purposely started trading this year, not because I normally do start trading the year on a much smaller scale than normal, just to kind of get my feet wet, but I also came off a really good run in 2021. And I know myself well enough after trading for literally a quarter of a century that when I'm making money and I get really basically bulletproof in the market and super confident, and then at that point in time is usually when I start getting hurt when I trade. But I know that well enough about myself that I really start to pare back my trading size. Like I was going pretty aggressive going into the months of November, December, playing the dollar on the long side. And if you guys are in the ForexAnalytix community, you knew I was pretty aggressively long the dollar going into last year, mid last year, and did really well. I mean, it was a spectacular year for me. But at the same time, I came into this year knowing I was on a high horse, and I took down my position size quite dramatically. So let me ask you this. Do you guys do that? Is that something that you do, that you have enough self-control to do it?
Morning. Hey.
Morning, Stel.
I'll answer with my personal experience. Probably my best year ever when I was working at the banks was 2008, which was the big crash and spreads blowing out. I was long spreads. I did very well, and I had basically by November doubled my budget, which was huge as a return, not a huge budget. It was a regular budget for a trader like me. And in December, I was like so bulled up, and this is amazing. I lost like a quarter of it within 2 weeks, so that made me change a lot the way I trade. So that was my big, and you know what, you don't want to be losing money in December when they're deciding bonuses. So it was a big faux pas on my part, and it's probably one of the worst things I've ever done, even though it was a really good year. So that changed me a lot, and that made me exactly like you say, you have a good run. I think twice about a trade, or 3 or 4 times if I'm having a good run, or I think about it a lot more than when things are more difficult, let's say, because you're going to have more confidence and more not confidence in terms of how should I put it? You get, or at least I got a little bit more arrogant, and you really don't want that.
Yeah, it's hubris. What I've done before that kind of calms me down is when you have windfalls like that, and brokers don't like hearing me say that, but you pull the equity and maybe put it into coins, something that you can't trade, or an investment, or
I knew you like Bitcoin.
T-bills.
I knew it.
With my profits, I could buy 1/10 of a Bitcoin today. And, then you don't have the same amount of money to work with. It kind of calms you down.
Yeah, that's not a bad idea. And I have done that in the past. I've actually taken profits where it just, like, let's say I'm just using numbers so everybody can relate. So like, let's say you have $100,000 in your account and you go on a good run and you make like 15 grand. Well, pull that 15 grand out, then you're back at square one, right? So now you only have 100 grand in your account. And then that 15 grand that you had in profits, even though it's like reallocated into something else and it's off the books, but according to your trading account, you're still at 100 grand, right? So it kind of retools your psychological thinking.
And it makes it real, because sometimes our accounts turn into poker chips where it's not real, it's just digits. And you take it out and you spend it or use some of it, then it's more real to you what you're trading. It makes it not just a digit.
100%.
Trade your trading account like it's a trade. You've put 10 grand, whatever you've put in, you've put money in an account, trade it like it's a trade. Treat it like it's a trade. If you get up on your money, as soon as you put money in an account, you need to think psychologically that money's gone. If I lose that money, I'm prepared to lose it. So as soon as I put it in an account, it's gone. So if you make 10%, okay, you pull your 10% out. Now you're only 9 grand down. You make another grand, pull it out. Now you're only 8 grand down. And if, so you treat it like a trade. Get yourself to break even. You're trading with free money.
Yeah. There you go. Now it's a great way to approach it. There's several different ways to approach it, and that is also a really good one, Ryan.
Yeah. We can do it.
Just real quick before we move on, because we do have retail sales coming out in 10 minutes, and I think it's we've got to pay attention because we got to see how the consumer is responding to these higher inflationary pressures. But K-Man, did you want to throw anything in here? If K-Man's here, I'm not sure if he is.
Yeah, I'm here.
Oh, there you are. Okay.
Morning, everybody, TGIF. Yeah, I pretty much join most of what's been said. Usually when I get over this kind of overconfidence when you're having a real good run. So I've learned over the years how to handle that. So I'm scaling down my positions, and I'm not shy of if I have a tryout or a break tryout, I'm not shy of taking like faster, smaller losses, just to protect the what is made, and only will add to positions if it's already starting to go my way. In that way, that I have already a little bit of advantage over on the setup of a trade, and then as soon as possible protect the P&L really. But yeah, we've all been there.
yeah, we have.
I went from banks to my private account. I started somewhere 2016. And with my very fresh still bank experience, I managed to triple my account in like 6 months' time. And then threw half of it away, and learned a very hard lesson from that as well. So yeah, it's all about managing and convictions. If like this morning, for instance, I wasn't shy of taking like 10 pips loss in euro dollar, 11 pips loss on the Kiwi, because I tried to run the morning model run, but it didn't work, so I just went out of them. It's not working, minor headache, back into my shell,
And this is an example of the trade room, so everybody can kind of see what K-Man's talking about. When we're in the trades room, we're talking about trades that we're taking and things that we're in, and obviously the general chat room and all the other chat rooms are more general conversations, but it's important to understand it. And K-Man, and I'm sorry, I didn't mean to cut you off, but I just want to say that it's really important to understand when you're navigating through the markets that there's not any one way to do things. And a lot of people get this common misconception that like, oh, I listened to the F.A.C.E webinar, so Ryan trades a certain way or Blake trades a certain way, so I have to trade these ways. No, there's several different ways to navigate through the markets. Whenever something's going higher, or something going lower, there's people on both sides of that trade, and there's different ways to make money, and there's different ways to navigate through positions and sizing. We just try to help you have a better idea of different ways to do it, and you have to find which way best suits you, because I don't think there's one shoe fits all. It's just not that type of thing. That's not what trading is. So hopefully, but by being in a community and being here on the F.A.C.E webinar, you can hear different points of view of everything, of what we're doing, and hopefully it does help you guys or gals moving forward. It's nice to have a support system where you can do that instead of being out on your own. So let's I'm sorry, I want to kind of move along just because we're running short on time here. Here's the dollar index. I blogged about it yesterday, and I've told everybody for weeks, hey, as long as we're above 94.50, I don't want to be bearish the dollar. And the reason why is because this was a pretty big breakout point. You go back here to 2020, and and KJ, who listens to the webinar every once in a while, or some of the time, sometimes he goes on streaks, but I've known him on Twitter for probably a good 8, 7, 6, 5, 8 years. I don't know. He might actually be listening in right now. He said, Blake, based on your tweet, you're implying that the dollar index will eventually break 94.50. Are you still bullish the dollar? So that when he tweeted that to me yesterday, it made me believe that he hadn't listened in a while and didn't realize I was turning more neutral in the dollar. But I can't turn bearish. So let me just put it that way. I can't really turn bearish until we get back below 94.50. I think we're going to bounce back to 95 and some change up here. I think a lot of traders are getting caught wrong-footed this week from trying to be a dollar bear a little late. If they weren't already pre-positioned, they were chasing the dollar lower. And you know what happens when you get some FOMO. But I want to get you guys' opinions here, because I'm going to talk to Daniel D. Martino Booth today, which I'm really excited about, because we're going to talk about the Fed and expectations and, how she feels about inflation. And this will help all of us have a better understanding on how to approach the dollar, I think, in the coming weeks. But what do you guys think about the dollar at current levels? Because obviously, Ryan, Stelios, you guys, and K-Man even a little bit as well, you guys were bearish to the dollar, but when the dollar was up here at 96.25, here we are, over 100 and 150 pips lower. Are you still bearish at current levels? What are your thoughts before we get into the retail sales?
Go on, Kay.
Man, you want to go first?
No, I'm not. I'm neutral right now, and even I still think dollar has a last leg higher.
Okay, so you think you don't think that like this uptrend is disrupted? You still think we could see 98? I still think we could go higher too. And I'm just trying to figure out in my head how the hell we get there. But
the problem,
how about this, Blake?
The issue I have with the Dixie is that it's $2 centric.
Sure, of course.
Too
Yes.
much euro-dollar in the dollar Dixie for me personally to really trade off it. I think the dollar may move higher, but we have to wisely choose the other side of a dollar pair. If the dollar trades higher, coupled with lower indices, you don't want to be long dollar yen.
Yeah.
But you may want to be long dollar emerging markets. Short cable, for instance, short Aussie, short Kiwi if the commodities come off at the same time.
And I guess the easiest way to explain that, K-Man, is the way I've been trying to explain it for the last few days is when the dollar comes down, I don't mind being a dollar bear, but I'm very selective about what currencies I'm shorting the dollar against.
Yes.
Right. So that's what it comes down to. Okay, Ryan, I'm sorry, we're running out of time. Ryan, what do you think?
pretty much what we said yesterday, when talking to Dale about this 94 level in DXY. If that breaks, you're going to be seeing euro dollar at over 15. We can't get there. So while you've got resistance up here at 14.80.15, you got support in Dixie at 94.50.
If Putin crosses the border with tanks, are people going to run to the euro? I don't think so.
Yeah, I know, definitely not. I mean, yeah, and I guess I don't want to put in people's head that we got to be looking out for those types of events. But in this case, Dale, we do. I mean, how do you guys feel about the Russia situation right now? I mean, and Ukraine situation. I mean, I always think it's a risk. It's like that lingering risk. Like instead of being a 5% risk, it's more like a 10% risk now, right? Something like that.
Risk.
Okay. Escalation. Escalation is what I mean. But anyway, but thanks, Dale, for bringing that up.
All right.
Stelios, do you have any opinion on the dollar? I know, like I said, you've been bearish the dollar, rightly so. Are you bearish here still?
I think we may be, we like you said, the DIX is gone 150 pips or whatever it was, and we could easily bounce. And funnily enough, Lagarde just spoke a little while ago, saying that we do need a accommodative monetary policy for inflation to settle in the medium term at 2%. They just keep going, and they're still dovish. But the Dixie, again, it's heavy on the euro. I think we could bounce because we are at the fib now, aren't we, or close to?
We are,
yeah. So I'm still bearish, but I think it's whoever has been also bearish, I think it's time to take some off now and anticipate the bounce to sell into. That's what. All right.
Well, Stelios, I'm gonna have to say this. Unfortunately, as we talked about Monday when we were down here. No, wait.
What is it? You're giving away more body parts of mine.
Yeah, we were down here, and I said, man, if we got a move back up to 47.50, I would give Stelios's left
nut
finger. No, I said finger. I said finger.
Yeah,
I said I'd give your left finger to be a short up there. We hit 47.50 to the pip. Now I'm trading the futures, so I had an ad, which was actually closer to 47.50, but in cash, it would have been 47.60. So it didn't reach my order. And the reason why I traded this so poorly is because I just didn't pull the trigger on that short, and I really should have. But boy, I tell you what, now that we're back down to where we should be, in my opinion, I just covered up my shorts this morning, right where we're at. I think we got to be a little careful as we head into the weekend. Now, we got retail sales coming up.
Yep, 20 seconds.
20 seconds. And maybe this is going to be the catalyst, right? Maybe this is the catalyst that drives the market. But here's the dollar yen. Let's put it on a 5-minute chart. And here is the data flash, which comes with your ForexAnalytix subscription. Let's look for those data. If you guys hear it before we see it, please scream it out. Thank you.
Okay.
Let's have a look.
The usual disclaimer.
Oh, here you go.
Steve.
Red export
Retail sales are not adjusted for inflation.
Yeah, these are all red. Revisions are red.
Down 1.9%
on
the month. Ex-autos down 2.3%.
No, it's not good. That means the consumer is their
core sales down.
Their butthole might be puckering a little bit. Oh, did I say that out loud? I say these things out loud. They come in my head.
The consumer has a strong balance sheet. They just don't want to spend it now, huh?
Yeah, well, look, and one of the things I'm going to ask Daniel DiMartino Booth today, and this is one of the conversations you can have with Julian this morning, which I'm excited to hear him with you here this morning, Dale. One of the things
don't get too excited. He's not in the house. So.
Oh, okay. Well,
there he is.
Okay, well, I think Julian will be a good person to ask this as well, but I'm going to ask Danielle DiMartino Booth today, just so you guys are aware. I'm going to ask her, about how she feels about like the quote unquote balance sheets of the American consumer right now. Here we got, retail sales, which this has been my fear. Obviously, the last, couple months we've talked about this. At what point does the consumer start to really, they start their consumer spending and starts to change because of these higher inflationary pressures. And I think we're seeing that today. And we see the dollar yen suffering as a result. So it's going to be very, very interesting to see this all play out here over the next couple of weeks. But I want to say, or next couple of months, excuse me. I just want to say TGIF, everybody, thank you for being supportive of the ForexAnalytix community, what we do here and our team. And thanks for listening in each and every day. Ryan, K-Man, Stelios, and Steve, you guys have a great remainder of your Friday. Dale, thank you for always being here every single day, and have a great interview with Julian today.
Cheers, guys. Thank you.
Cheers, everybody.
Bye.
TGIF.
Thank you, team. Have a great weekend, everyone. Just trying to promote Julian up here. For some reason. Not letting me. Blake, if you're still around, whoever had the screen left, I can't.
Oh, I'm here.
Can't promote him.
Let me see.
What's the name?
Julian Brigden.
Let me see here. See what we can do. I was just going to get coffee, but Steve's on the case here.
I don't know why it's not working for me.
I'm trying and it's not working for me either.
Yeah.
So, Steve?
I wonder if he's doing it by phone. Maybe that's
we can. I just clicked. Oh shoot!
There, he's there now.
He's there. Okay.
He's there. I see him up on top, so I don't see him on the bottom though. Let's just trying to mute him. Hi, Julian. I can't unmute.
Hello.
Hi, Julian. Sorry about the technical issues.
No worries.
It's a pleasure to meet you.
Pleasure to meet you too.
Yeah, I was looking forward to talking to you. I've read some of your things. I'm not sure if you want to share your screen or not. If not, I could do it while we run down the markets. Your call.
We're not using cameras, gents?
No.
Okay.
You don't need the camera, but I was going to show, I'm not sure if you were going to bring any charts to talk about what I know that you're a big dollar bear here, and I wanted to talk to you about that. So why don't I just go ahead and I'll share mine, and we could go like that and talk about different markets. So there you go, Julian. There's your website.
Okay. Perfect.
Markets are noisy, and you may calm all the chaos. So you've been busy. Yeah, and I'd like your secret to making calm all the chaos. But why don't you tell us? I know you've gone through so much. You've been with a lot of different firms, and a little bit about your journey, and maybe what were important turning points for you during that process before
during that multi-decade process. Now, yes,
I know. Me too.
Yeah, exactly. These grey hairs are one. Honestly,
silver, Julian. Let's start calling our
silver.
Right.
That's true. So I started as a young whippersnapper, sort of actually before I even left university. I did a year working for Fibro, which was the commodity group, and then subsequently became Fibro Salomon, and then Salomon. And I started trading precious metals. That's why I got into trading precious metals. I traded the silver book for a while, and then I worked for Credit Suisse in Zurich, where I traded precious metal options for them in some pretty volatile times where the vol of silver hit. Actually, I sold an option at 112%. I remember that, and finished off my university degree. Ended up working for a name that some of the older members will remember, Drexel Burnham.
Oh, sure.
And then
Michael Milken. Did you ever meet Michael?
No, I was in the London office, and it was very demarcated, as I discovered from my girlfriend at the time, who was an auditor and explained that the company, this is like, I joined a year before it went bankrupt. She came to me one night and she said, you really need to leave. And I was like, why? And they said they're doing intercompany transfers between various divisions, lending money between various divisions of the firm, trying to shore up the balance sheet. It's completely illegal, and this thing is not going to last. So I had like a 3 months head up that Drexel was going down. But the one thing that Drexel did for me, I moved into FX, and then I went from there to HSBC. And then from HSBC to Lehman Brothers, where I ended up running the sales team in London and New York for a while. And that's where I kind of cut my teeth.
You're jumping from blue blood firm to blue blood firm with nice upfront money deals, forgivable loans during that era.
I couldn't possibly comment on that, Dale. All I will say is that my best mate was my headhunter, and every 18 months to 2 years he seemed to successfully, for himself as well, make a lot of money by walking up my compensation package steadily.
See, we were in the business before the Bataan Death March of eliminating trading floors, etc. Ever spend any time on the trading floor?
Oh God! Well, all the time. It was all the time. No, not actually. Oh, on the floor. Yeah, for a while at Drexel, I did the cash to IMM ARB.
Oh, okay.
So I went. Yes, exactly. So I went to Chicago, and I had my brokers there, and actually, I was trading it the day that, God, this dates me. Dollar Mark was trading over 2. And then the US current account deficit number came out, and it was a blowout number, and the dollar started to collapse. And at one point there was, I want to say, a 3 big figure divergence between futures and cash. 3 big figure.
I can make you feel younger, Julian. I was there. I was there on the CME floor when they were using a chalkboard for currency trading. The IMF had just opened. You don't remember chalk, do you? They actually did. They were trading currencies on a chalkboard.
I hear that from my daughter once in a while, and she's and she's trying to be sarcastic. So, Daddy, did they use smoke signals when you were trading the market back in the early days?
No, you were able just to erase the trade off the blackboard. So, all right, let's get to, this is a very important juncture, and the debate is, and I know from reading your work that this was a big event in the dollar. You believe that this is only the beginning, that this whole rally in 2021 most likely is a bear market rally, and you're looking for a 30% drop in the dollar over the course of how long? This year?
Here's the thing: the models that here's I think the fundamental thing that people don't understand. The US, by virtue of the fact that it is the reserve provider, is obliged, in inverted commas, to essentially run external current account deficits, either current account or capital account, and that is because unless they do, they can't provide reserves to the rest of the world. They have to, to oil the machinery, to oil the cogs of global trade, you need to provide reserves in, to a world that conducts its trade in that reserve currency. And the way you do it is typically run this current account deficit. And that's fine, right? And we've been doing it since, the post-war period, where the US has clearly been the reserve provider of choice. But, if you go back and you look at history will tell you that, one of the things that happens that causes the demise of the reserve currency is that you just slip into bad habits, right? I mean, basically, the world is subsidizing you because they're buying your assets and allowing you to import all these goods. You're sort of symbiotically providing them with the reserves, but there comes points in times where people go, geez, I've got an awful lot of these reserves. And we've been doing the same thing, right? We've been running an inordinate budget deficit. We've been running an inordinate trade deficit. And that was fine up until, I would say, 08. And then, and I say up until 08, and really actually probably even before that. I mean, in the post-war period, this sort of symbiotic relationship was pretty simple, because frequently or usually the reserve provider is also the most powerful military state. So, think of the UK up until the First World War, and then, it sort of wanes a bit.
What were their bad habits that caused them to lose reserve currency status to the dollar?
I mean, the deficit. I mean, we just ran up too many debts paying for World War One and paying for World War Two, right? And they essentially, post World War One, had to effectively default because they rescheduled the war loans, and they'd had to borrow a lot of money and sell off a lot of land and do all this sort of stuff. There was all this sort of land lease stuff that Churchill did during the Second World War, right? I mean, fighting wars is bloody expensive. Right? Very, very expensive. And so, but it does go hand in hand with this. And usually, or certainly the US, I would say, up until the emergence of China sort of post its WTO membership entry, had a relatively balanced kind of relationship, because it was really being funded by the countries that it was providing the nuclear umbrella to. So South Korea, Japan, Germany. And so when you kind of got your allies as your funders, things are not that unstable, right? So then China comes in, it starts to displace some of these other people as the major exporters to the United States. We run up a deficit with them. That has created a natural instability, I think, and something that's structurally a little dangerous, and I do worry about occasionally. But perhaps not immediately, unless you really want to put your tinfoil hat on, Dale, and start thinking that the Chinese are going to, devalue the dollar by starting to sell treasuries and this sort of thing. Not an immediate problem, but there's another vulnerability, and that is the fact that certainly since 08, the nature of the way that we have funded the deficit has changed dramatically. And I think that's a function of the steps that the Fed has taken from 08 in terms of QE. And what they've done.
Julian, do you think that the Fed welcomes a weaker dollar because it makes it easier for them to go ahead with the taper and tightening without blowing up emerging market economies, and actually attracts more people to treasuries by letting the dollar go down and rates go
in
up?
part, but I think the problem in part, look, certainly Treasury seems to have changed its tune. Janet has talked about this. And, I think they recognize the vulnerability of the United States running such a huge current account deficit. We're back, if you look at the latest quarterly numbers, and they come out on a quarterly basis, if you annualize those, we're back up to the extremes of the deficit that we were in 06, 07. Right? So it's running at about $1 trillion a year now that we're relying on foreigners. But I think the real vulnerability comes in the nature of how foreigners are funding it. And the reason I say that, as I said, in the sort of pre-2000 days, and even with China, the deficit's funded by strong hands of foreign mercantilist central banks buying dollars as the dollar weakens, or they receive those dollars via their exports of their exporters, and cycling those back into treasuries, right? And
Yes.
those hands are referred to as sticky hands. They tend to not to shift those exposures very much. They'll hold them. They don't trade them. They're not really worried about the exchange rate, right? This is kind of the piggy bank that they have on a national basis. And that's all well and good. The problem is that since really 08, we've seen, and the Fed's moved to essentially use QE and edit depress bond yields relatively as a result, yields have not been very attractive, right? And we now know that we're running extraordinarily negative real rates. And so it hasn't been a very sexy place for anyone to put their money into treasuries, right? And we've seen, the likes of the SMB in particular decide, screw it, we're not going to, why buy treasuries? We can go and buy Apple, right?
Yes.
We can go and buy Apple and stuff. And that's great in a way for them. It's not great for us because, we go from funding our overconsumption and our resultant deficit from a piece of paper that we can sell them, which is what a treasury is, to a share in a truly tangible asset and a piece of corporate America, right? So we are selling kind of the crown jewels, to use the expression.
Okay. Can you believe, Julian, that people were calling the FANG stocks a flight to quality and a safety trade, that they were? I can't make it up. This is what people were saying. That especially the crypto guys, when they went to cash, they didn't go to cash. They went to Amazon. They went to Microsoft. They went to Apple, and they parked their money thinking it was safe. And I don't know about your training, but something that goes up tenfold is usually not a risk-off asset.
Correct. Correct. And I think this is the problem, Dale. I mean, I think, I'm beginning to wonder whether the mechanics around this current account deficit, right? Remember, the current account deficit, I mean, you can get bouts of instability. If you're an emerging market and you run a huge current account deficit, there are times where you can get into trouble, right? Because we know that in emerging markets, what tends to happen, I mean, look at Brazil, is a classic example. They run a big current account deficit, but it's all funded with super hot money, right? It tends to go into the short-term depots and 1 year instruments and 6 month instruments to sort of pick up carry and then all of a sudden something goes wrong and the money just evaporates. It doesn't trickle out, it goes, right? Goes.
Yes.
And the edifice doesn't just crumble, it collapses on you, right? I mean, just literally implodes, like one of those disaster movies where the high rise just crumbles in front of you, right? So I guess the US is lucky in the sense that the money is somewhat sticky, but there is absolutely no question that people are excessively overweight US equities on a relative basis. And if you look at, US investors, they probably should run 65-35 US to overseas equities. I bet you that, and I've talked to friends of mine who run big RIA, retail businesses. They're saying that, they can't get clients and they haven't got any clients who are really in overseas. Maybe they've got 10%. And I think that whole sort of metric is carried on globally. Everyone is overweight US stocks, and foreigners have I think, an extraordinarily dangerous dynamic, and that they've basically been playing, twofers, right? They've been getting 2 for 1, which is what that expression means. So they've had a strong dollar, and rising outperforming US equities.
Yes. Okay. So
that creates an unstable dynamic, right? That creates a very unstable dynamic. And so when you look, and you just showed the chart of Apple, right? When you look at Apple or you look at Google, Alphabet, right? You see these very, very abrupt rises, right? Post-COVID. If you take it back to sort of 2019, if you can.
We can.
2019. Yeah. So here you've got a stock that sort of pre-COVID, had been stable for quite a while, around 1,200.
Yes.
Right. It's a great company. Don't get me wrong. Right. You never create. I've gone back and looked at all bubbles, Dale. Right. Going back as far as I can, and typically they're created in something with a spectacular narrative. Right, where there's a fundamental underlying story. About the only one that I can't make any sense of was the Dutch tulip bubble. I struggle with that one, but a classic was the opening up of the Argentinian of Argentina via railways, which were funded by and large by British and European investors. And, the idea was you were going to get Argentinian beef and you were going to export it to the rest of the world. And it's going to be super cheap. And indeed, it was transformative. I mean, if it hadn't been for what was referred to as Argentinian bully beef, we wouldn't have been able to slay millions of men in the First World War because we wouldn't have been able to feed them in the winter. And typically what happened is wars stopped in the winter and everyone went home, but not the First World War because we could feed them. So to say that this wasn't transformative is wrong, but the point is the investors lost a shed load of money, right? And this is, when I look at this Google chart, you break out on basically the back of the Fed's QE, right? They just drive this thing higher. It goes into the stocks where the narrative is the strongest, where these Cathy Wood's ARK is a classic example, right? A super long duration stock as yields get suppressed, and we create bubbles. And now, you've got this twofers trade on where you're Johnny Foreigner, you're overweight versus your benchmark US stocks. It's been an amazing trade. They crushed your domestic indexes.
Yeah, one of the best.
But you're unhedged.
Yeah.
And you're very, very long, very, very expensive US stocks, right? Very expensive US stocks. And there is an instability there. Now, maybe it doesn't go yet, right? Maybe it doesn't go. Maybe the earnings are so good, right? Just note the slight tone of sarcasm there, because I think it's fully discounted, as we can see with the banks. Maybe the numbers are just so good that it isn't a problem. But what if it is a problem?
Microsoft.
Right.
One of the monsters. So what I'd like to know, Julian, is if you are bearish as dollar, and there has been outperformance by Europe and emerging markets the last 3 weeks to a couple of months, right? So it's just
but it's not really kind of positive outperformance. It's US. I always refer to this, Dale, as which way does this thing end up? These divergences end up correcting. The nice way, the US kind of goes into a sideways funk for a while. The rest of the world catches up, and you have a gradual removal of foreign money from the US markets. Or the nasty way. The nasty way is everything goes down because the US equity market, arguably bubble in certain sectors bursts, right? And the NASDAQ goes down 40% and the Euro stocks only go down 20, right? Okay. The divergence collapses, but you still lose money.
Yeah. So on your dollar call, are there fiats you like against the dollar?
I think
what would they be?
Ultimately, you've got to be in the currencies that have funded the deficit. And predominantly, that's Europe.
Okay. So Euro, how about some of these commodity currencies like the Aussie, Julian?
It's a tough one because I think the problem is if you go, yes, in theory, right, a weak dollar should be good for commodities, but by and large, these countries produce non-precious commodities, right? So in other words, ones that are linked to industrial activity, correct, sir? So I'm not sure that that's where you want to be. I think this could be an environment. And as I said, we're not there yet, Dale. There's some clues that, I'd be looking for to suggest that these flows are reversing.
Yes.
Okay.
Give us one.
Like
looking for.
Yeah, I mean, the relative price action in various time zones. So if I start to see the euro come under pressure, say in the US time zone as stocks are sold off because people are viewing the dollar as a safe haven, but then we walk in and we find during the European time zone, as say S&P futures come under pressure, that the euro isn't going down but is going up because it's Europeans selling their S&P futures and converting them back into euros, then then that would be a clue to me.
Okay. So that would be a market tell. So you pay attention to different time zone trading.
Correct.
To see. Okay. So if you don't have to pick fiat, the metals are trying, Julian.
Yeah, I mean, gold and silver to me. I think, I'd love it if we got silver
down to 19.
Yeah, exactly.
You and me are dreaming the same thing. So
yeah, I mean, if you've got a little bit, I don't think it's heavily owned, so I'm not sure that's going to happen, Dale. But I would like a VAR event to get silver back down to that sort of, where is it?
How about this for a vol event?
1920 sort of level.
Yeah, I like that level. How about this for a vol event? Putin goes in. Are people going to buy the euro or buy the dollar? I mean,
no, and that one, you'd get a big spike in the dollar, I think, because that is truly a geopolitical one. I think then you'd see how it would pan out, and I think the other thing is you'd get these central banks kind of step back from the idea of removing accommodation. So that actually, I think, would continue the sort of bubble phase of the US, or the dominance of the US, where the Fed comes back in, you get a sell off, the Fed would come back in, everyone will go, what the hell does it mean for Microsoft, right? And the answer is nothing, from an earnings perspective. And then you sort of continue that. But the fundamental problem here is, Dale, that the Fed needs to now remove accommodation, not because of inflation. Look, we've got clearly inflation. We've been in that camp since March of 2020. We started to put our first inflation trades on. And we've been banging that drum for a long, long time. But now they need to remove accommodation because we've closed the bloody output gap, right? This is an economy where the nominal GDP output gap, which we didn't close after a decade post the GFC, right? 2019, we were sort of close to getting back to trend nominal GDP growth. This time we did it in less than 2 years, right? So we now have 3.9% unemployment, right? I'm told that the internal number within the FOMC is 3.8 for full employment. So we're going to be there next month probably and well through it, right? They've got wage growth and they've got an economy which is growing at about 6%, which is double trend. Right, double trend.
Well, let
me
ask you
need
this.
to tighten to slow the economy.
Slow demand is all they can do.
Correct.
All right. So you know what? Are higher rates going to take the price of beans and corn down and coffee down and things that grow out of the ground? Are you going to go on a diet because the Fed is raising rates?
And the answer, no. But I am cautious because I think these commodities are quite heavily owned now. And if we get a VAR event, and this is the problem with Bitcoin, right? I mean, I was chatting with Raul the other week, right? I mean, I do think that Bitcoin has been a beneficiary of this excess liquidity by the central banks. To my mind, there's no question of that. If the dollar goes, would it be a great, could it be a great trade? It could, but it is quite heavily institutionally owned now. Right. I mean, I think, this is chart. And I think if you look at those lows and highs around 38 to 40,000, it's not a bad place to try and have a stab at buying it. But do be conscious. This is owned by players who have positions in other assets.
Yeah.
And if they start
markets.
and if they start to sell off, Dale, we know what happens, right?
Yeah.
You know, I've sat on enough
Sell the
trading funds.
kitchen sink if you need
Yeah,
to raise
everything
cash.
gets sold, right? The guy, because the guy at the hedge fund gets a tap on the shoulder from the risk manager who says, cut your book by 30% because the vols are up.
Right. Well, Julian, I tell you, I really am glad I reached out to you, and I appreciate that you were open to coming to our little venue and sharing your views, having a giving spirit and sharing your views to our community here at ForexAnalytix, and would love to talk to you again as things progress. And it's going to be an interesting dollar call. I'll ping you if silver gets to $19. So
yeah, please.
just in case you're like me looking the other way and
looking the other way. Yeah, looking the other way. Exactly. And look, if any of your listeners want to sort of follow me, you know, feel free to ping me or to follow me on Twitter. That's probably where I'm most active, at Julian MI2. You can see it up on the top there. And then you can
have a free newsletter here too.
We do have a new free newsletter. It's really good. It tends to sort of analyze a lot of the stuff that's going on from policymakers and some of the other developments we think are kind of interesting that are in the public domain. So it is curated and commentary. It is, you know, it is done by the team, and we do put effort into it. It's not just a freebie piece of crap that some of these things are. That's designed just to get your email. You know, we do put effort into it.
Really appreciate being able to meet you, Julian, talk to you, and after someone finishes an interview with me and they survive, you become a trading warrior, brother. So
thank you very much indeed, sir.
All right, so really great way to cap off the week, Julian. I hope to be able to continue our conversation down the line together.
Thanks, Dale. Much appreciated, sir.
All right, so
cheers,
cheers, Julian. So that's it, everyone. You could join the team in the Morning Edge and have a great week. Remember, most of all, don't just count your pips, count your blessings. And we laid it all on the court for you guys this week. Do your work over the weekend, and I'll see everyone Monday. Adios. And thanks again, Julian Brigden.